understanding the perspectives of both not-for-profit and for-profit social enterprises in leveraging these instruments. This session will be facilitated by Aparna Dua from Asha Impact and Tushar Thakkar from Dalberg. Aparna Dua leads this think tank at Asha Impact. She has over a decade of experience working across impact consulting, government advisory, and blended finance, especially in education. Tushar is an associate partner with Dalberg Advisors based in their Mumbai office. Tushar leads work in the development finance and investment space and also leads work in the skilling and livelihoods area. Before I hand it over to Tushar and Aparna, I would just like to mention that this session has 3 different segments. This is the first one. It is going to be a masterclass. Over to Tushar and Aparna.
Good afternoon, everyone. I hope you all had your tea and are ready for this session now. We have 3 segments, so Tushar and I will kickstart the first one, which is just laying down a couple of principles of what blended finance is. It's becoming a buzzword now, and rightfully so, if I can say that. So hoping that over the next 25 to 30 minutes, we can take you through what blended finance really is, why is it that everyone's talking about it, why should we be talking about it, what are some of the instruments that we've used, that we've seen used in the Indian landscape as well as globally. And then would love questions from the audience. We understand that this is a new space for everybody, so please feel free to charge us with any questions that you have, and Tushar and I will do our best to answer them. With that, I think we're ready to get started. So if I can request if the presentation can come up. We understand that everyone is perhaps in at different stages in their journey, just understanding what blended finance is. We've heard a lot of jargon, SIBs, social impact bonds, development impact bonds, social success notes, etc. So we'll try and keep today's conversation fairly jargon-free to the extent possible, but make it informative enough that when you leave the room today, you'll be able to talk about it with a lot more confidence, we hope. And we'll try, like I said, not use too much jargon and keep it fairly light, not getting into very technical stuff, but obviously happy to take up any of those questions during the Q&A or after the session as well. So to begin with, like I said, today, you hear people talking about impact investing, ESG, SRI, there's commercial investing. So it's all, broadly a spectrum, as you can see here. On the extreme left-hand side, you have commercial investing, which is possibly, what we're all sort of familiar with. It could be in the public markets through stocks, or it could be in the private space through, VC and PE investing. As we move to the right, that's again something that I think all of you are, potentially experts on, which is traditional philanthropy. The grants for all the impactful work that is happening on the ground. Now, blended finance and impact investing, just left of that, because we are still talking about financial returns to some extent, and that is an important aspect of it. But we're also talking about intentional impact. So over the course of the next 25 to 30 minutes, we are going to do a double click on blended finance and an aspect of that which is known as outcome-based financing or results-based financing. And we'll get into what that really means. But blended finance, very simply put, as the term suggests, is blending of 2 forms of capital. There is philanthropic capital as well as commercial capital. Philanthropic capital could be coming from a variety of different sources, and likewise the commercial capital. And the 2 are, prioritizing, different returns. For philanthropy, it's more social returns, and for commercial capital, it's financial returns. And the reason why, this term is now over the last decade or so has been gaining such importance is, you hear about the billions and trillions that we need today if we really want to meet the SDGs by 2030. Layer on, the entire angle of climate finance that is required and the climate mitigation and adaptation goals that all the countries are setting for themselves as well. So where is all that money going to come from? When you look at government pools of capital and philanthropy, that itself is not going to cut it. And there is trillions today sitting in the commercial, in the capital markets across the world. So how do we make that money, that capital work for us and work towards social and environmental goals that we set out? And that's really why blended finance becomes important, because you're bringing in commercial capital, you're bringing in philanthropy, putting it together to meet these objectives. There are 3 dimensions or levers for blended finance. The first being the returns aspect, as I mentioned. So these are financial returns, because commercial capital is only going to look at this when they actually see this as a financially viable investment opportunity. The second, as you can see, is leverage. And here, as I said, philanthropic capital is really bringing in or co-opting commercial capital. So leverage becomes important. If we keep doing philanthropy the way it is, we're not really going to be able to move the needle that much. But the minute you're talking about leverage, you're going to be able to create that much more impact. And hence the leverage aspect becomes really important as well. And the third aspect is impact, which I've also touched upon. I think one very critical point to make over here is that blended finance, given that it's the coming together of these 3 levers, is only applicable in areas where you see financial returns, impact, and leverage at play. There are still very critical areas where grants are going to continue to be sort of the mainstay instrument. This is not doing away with grants. This is just giving us another quiver, in our toolkit, really, to say, how do we create the impact that we really want to see? Very quickly, there are different instruments that we can be looking at when we talk about blended finance. The first, if all of you can see the screen clearly, is concessional finance. Very simply put, as the name suggests, it's concessional in nature. This could be in the form of concessional debt, it could be concessional equity, and concessional doesn't mean it's only on financial returns. It could be concessional also by the terms in which the money is made available. For example, if the debt is being offered, maybe the time horizon in which the repayment is due can be extended. So concessionality can happen in different forms. Maybe you get like a longer time period to pay it back. So that could be one way of doing concessional finance. The second, guarantees, as the name suggests, is philanthropic capital is actually providing a backstop measure to say, if for whatever circumstances the borrower is not able to repay that money, we're stepping in to provide that guarantee, and this could take the form of first loss capital or partial or even full guarantees if you're talking about something very innovative or high risk. I'm going to skip the third, and because that's what we're going to be spending a lot of time on. But the fourth one is, technical assistant grants. We've seen this, play a big role, globally as well as in India, because when you are talking about, innovative interventions, often you're talking about high risk as well. So here, technical assistance grants, which are capacity building grants, or, backing certain innovation that we want to see happen, and involves a high risk. This is where a TA grant can actually be helpful. RBF, or results-based financing, very simply put, as again the name suggests, it's tied to certain results or outcomes. So only when certain outcomes are met is the investor going to get their money back. We've seen, we've heard about development impact bonds, we've heard about social impact bonds in the context of, say, US and UK, and now we're seeing some of this sort of emerge in India as well. Social success notes. So all of these are different forms in which financial returns or incentives are tied to meeting of certain development or environmental outcomes. So I say this a lot, blending is trending. So we've seen a gradual increase in blended finance in India, and as of last year, as per a recent research that we had done, we've seen that the volume for blended capital has actually touched about $1 billion in India. Globally, over the last decade, this has been about $160 billion. So think about the number that I talked about at the start, right? We're talking about trillions that needs to be mobilized. So this is still a small part, but the good news is that it's increasing. And I think that's really the message that we want everyone to take away today. In India, a lot of foreign international foundations, development aid agencies have actually been pioneering a lot of these instruments here. And then on the right-hand side, you see a lot of private investors, which is, the money has really been coming from NBFCs and banks, which is unique to the setup in India. And we hope to see this grow. We hope that more domestic foundations, domestic philanthropy, family office can now start looking at this, as an interesting area where you can do well and do good together. So where has all the money been flowing? If we look at the sectors at large, and this is something maybe you'll all resonate with. So I think when you look at philanthropy, I think education and health come to mind. But here, because we're talking about financial returns, we also have to look at mature business models. So energy and financial services have been driving a lot of that value coming in. But from a volume perspective, livelihoods, financial services, agriculture have also been right up there. When we talk about results-based financing, which is what we're going to go deeper into, and Tushar is going to be sharing a lot more insights on that, we've seen education and skilling emerge as sectors. Healthcare has also been very important, and now we're seeing the use of this across WASH and other sectors as well, as more and more people are learning about this and seeing how they can leverage this, like I said, as a tool to raise more capital from the private market as well. I want to spend some time here because I think this is a very important point, right? When we talk about leverage, we've seen that we are starting to see, even in the India market, leverage of about 5 times. And what does that mean? If under traditional philanthropy, if earlier you had been spending, say, 100 rupees, that was getting you to a certain level of impact. But now think about that. When you get 5x leverage, that means you're creating at least 5x the amount of impact for the same money that you had put in. I'll let that soak in for a little bit, because this is why blended finance, we feel, is really the way forward if we really want to talk about the impact and scale the impact that we really want to see. Different instruments have seen different types of leverage, the most being on concessional capital for reasons because these are instruments that are easily understood by the financial market as well. But as these instruments are reaching more maturity, we are going to see the leverage rise as well. Results-based financing has seen leverage anywhere in between 2 to 3 times, but we do feel as these instruments mature as well, the market currently is nascent. But there is rising awareness. As and when these instruments mature, we do see that the leverage will also go up. So why should we be looking at some of these results-based financing instruments? So I think there are 3 main reasons, and one can look at it from different actors involved, right? So one is the donor itself. It's actually driving a lot more efficiency for their capital. They're only paying if outcomes are met. Now, when you look at it from the lens of an implementing partner, which I assume is a lot of you sitting in the room today, it's actually giving you flexibility in the way you run your programs. There's nobody asking you for line by line, okay, how have you spent the money that I have actually given you in the form of a grant, but you have flexibility. If something is not working, you're leveraging data, and Tushar is going to be talking about this in some of the early evidence. But you, as a nonprofit leader, have that flexibility to say, this is not working, let me try something new. And everybody who is involved in that transaction or that project with you is supporting you, because ultimately you're focusing on outcomes. And the third is very important for the sector to move forward. We do need to be talking a lot more about data and what actually works on the ground so that you can scale those interventions. And so evidence on actually what's working on the ground becomes really important. So when you look at it from an ecosystem perspective, you look at it from a nonprofit or an implementing partner perspective, or you look at it from a funder perspective, there is a lot more that you're getting through these transactions just by the way they are designed, because there's a lot of focus now on outcomes and everybody is working on that. Having said that, this is not by any means a silver bullet, and there are certain conditions which actually are required when when you're looking at an outcome-based model, right? The first and foremost, what you're doing is that actually measurable. If I can't measure that, there is no way I'm going to be able to tie financial incentives to it, right? So that's where a lot of these instruments require time and structuring, because baseline data is missing oftentimes, or there's just no good way to measure, what you're actually doing. That doesn't mean it's not impactful, but it does need to be measured if you are looking at it under an OBF framework. The second really is, I talked about data availability, capacity of the consortium members, right? Because now you're talking about everyone sort of bringing their focus onto just outcomes. So do you have that flexibility and that agility within your organization to actually take decisions based on data and say, okay, I have been doing something maybe for the last 10 years a certain way, but now data is telling me this doesn't work. Can I as an organization stand up and say, I'm going to change that? So that becomes important from an organization lens as well. And obviously then I think, since this, I mentioned this is a fairly nascent stage, so there are certain costs that are associated with designing it, structuring it, doing evaluation, doing the program management. So is the problem that we're trying to solve actually large enough is something we need to ask ourselves, because initially as the market grows, we do see these transaction costs and the time to structure, we will see that come down. But as it stands today, this can be, sometimes a bit of a limiting factor for, who considers whether, OBF is really for them or not. And lastly, looking at whether the intervention that one is talking about, whether it has been, piloted before or not, that matters. Because while there is a certain risk element, you're saying that, okay, I am going to, test out something new, or I'm going to test it in a new geography. But having, some evidence to say that this has actually worked before and now I'm looking to scale this up is also important. And we'll probably go deeper into this as Tushar talks about some of the case studies and evidence from some of the early bonds that we've seen in the market. So with that, I'll hand over to Tushar.
Awesome. Thank you, Aparna. Thank you very much for that. And I'll start off with some of the case studies, as Aparna indicated, and talk about how everything that she said has actually been implemented, and about how a lot of this is actually translated into action on the ground. I'll start with two examples, selfishly, because these are both that Dalberg has been involved in, and then where we've done a little bit of work. The first one is the Skill Impact Bond. I see a number of partner organizations also among the crowd here. This is an impact bond which has been an outcomes-based financing instrument, which has been implemented with with a consortium which includes NSDC, so that there's government participation here, government buy-in here, with a focus on trying to see if the skilling ecosystem that we have can be transformed from what was sort of a more inputs or outputs focused ecosystem, where training was considered to be the primary sort of objective, to something which can then be linked to actual achievement of outcomes linked to retention, not just sort of getting jobs, but also looking at retention of individuals in jobs. So this is a program which is ongoing right now with 4 implementing partners. A few of them you'll hear from in the later session as well, with the objective that, and we sort of all agreed as a consortium that if we are looking to target this challenge, we should go from, not just looking at some of the easy to solve areas, but to make sure that we are targeting individuals, demographics, and problems which are slightly harder. So there are a number of commitments. So there's a significant gender lens commitment that comes in as a part of this, but also different types of partners that you'll again hear from later, who are working in geographies and demographics which are quite difficult. So this is an ongoing program. The Quality Education India Impact Bond is something which has been implemented and closed. And here the endeavor was to basically learn from the first impact bond that was done with Educate Girls and try and scale that up. There was a smaller one, the first one, which was piloted. And here the idea was to see if, having direct education focused interventions which are able to drive student level learning outcomes, and therefore payments being tied to student level learning outcomes, can that actually be achieved? And then this was an about 11 million bond which closed last year. They actually went through the COVID period when there were significant shutdowns and quite challenging for the implementing partners to operate on the ground. I'll talk a little bit about how they performed, and they performed extremely well, even during that COVID period, sort of reflecting back on some of the things that Aparna said around how an outcomes focus helps or how having flexible capital helps. A couple of other examples which go beyond just sort of the more portfolio-based impact bond approaches that have been seen. The first one is essentially more of a debt instrument. This was, a debt provider essentially provides, money to healthcare enterprises that are looking to sort of scale up healthcare services. The idea here was that subject to the achievement of certain healthcare outcomes, part of the interest is set off by the philanthropic donor. So this ties in, again, it is outcomes focused, it is an outcomes based instrument, however, it is tied with a sort of instrument that is very well understood. Debt for enterprises is a very well understood instrument, and here the attempt is to see if reducing the cost of capital can actually incentivize outcomes. And what you see on the other side is basically a systems focused impact bond, Utkrisht, which was again implemented with an objective of looking at how an healthcare system can be transformed, thinking about how healthcare enterprises could align with what the requirements of a state healthcare system might be. This was implemented again with 40 plus organizations, about $9 million in size, and again, a fairly strong outcome. So, the objective of basically trying to showcase some of these instruments was to emphasize that there are different ways of approaching it. Of course, there's the fairly heavy impact bond structure, which makes sense if there are different contexts that you want to test for. There's a particular scale that you want to target. However, there are also different approaches that can be taken. For example, if the ecosystem itself is more of a for-profit ecosystem, or if there's an established instrument or a financing instrument like debt, which exists, and then we want to leverage that to then drive an outcomes focus. So I think that, so different sectors, we've focused on education and livelihood and healthcare here, but if we look at global examples, while these sectors have been the front runners, there are a wide variety of different sectors which have seen instruments of these kinds. So I'm going to maybe move on from just the examples that we have here to some of the learnings that we have gleaned from our work and from the work of different sort of ecosystem partners around this, and whether a number of things that Aparna said were hypotheses around whether the utilization of these kinds of instruments will actually lead to particular outcomes. What we'll share now after this slide will be what have been the early trends. Have we actually seen some of those hypotheses actually play out? And maybe we'll touch upon that in the coming slide. So maybe 4 or 5 high-level learnings to highlight. The first one is that incentivization towards outcomes seems to have worked. The hypothesis was that if you say we'll only pay for particular outcomes, is that going to result in that outcome being achieved? At least what we've seen based on the impact bonds that we worked on, that seems to have worked. I've given a couple of examples. There's a skill impact bond where the prioritization or the focus is on a 3 months retention in job. We are beginning to see that the outcome results that we have for the impact bond are close to 2 to 3x of anything that has been seen in the ecosystem. Of course, there are programs which have done really well, but when we look at large-scale programs, this is beginning to see 2 to 3x the numbers. And this is keeping in mind that the significant gender lens, it also operates in demographics which are often harder to reach. So we are seeing some fairly strong results. So again, sort of proves the hypothesis that a focus there helps. Similarly, and this is of course an ongoing program, but if you look at the Quality Education India Impact Bond, again, the focus on student level outcomes has actually driven significantly better outcomes. This was a fairly rigorous MEL exercise which was carried out with control schools, etc. And the results that came out indicated that fairly strong student level learning outcomes were achieved. Again, that was the focus indicator that was being utilized here. So that was sort of one of the early learnings. The second one was, I think, a slightly more nuanced one. Aparna did touch upon that, but the flexible funding where there isn't constant sort of focus on, line items, where does money go, how did you utilize it, etc. Taking that away and providing flexible funding and saying that, look, you can innovate, you can change your approaches if you need, but, with a focus on being able to achieve a particular outcome. Again, that seems to have helped. We've put one example here where, Educate Girls is a well-known example where it was a 3-year impact bond, started out in the first couple of years with results not being as expected. However, with the organization itself sort of iterating and innovating to be able to significantly outperform outcomes expectations by the end of the 3rd year. So this is one example. I can also maybe, even though it's not on the slide, touch upon how the implementing partners in the Quality Education India Impact Bond were able to operate through COVID. This, as I think all of us are aware, was a fairly challenging time for the education ecosystem. Even during that period, the bond did run. Of course, the consortium had to come together to, change some of the parameters that were required for the partners to operate under. However, results were delivered even within that period. And that sort of ties in with what we have seen with the third point. There was this big fear, and I think, again, Aparna touched upon the point around capacity of the consortium members, capacity of the ecosystem to actually operate within a structure which is quite different from how it has operated traditionally. What we've seen is that, candidly, I think what comes up often is that there are a large number of non-profits who are doing really good work, but are they able to actually transition and operate within this kind of a structure? I think that, again, what we've seen through the bonds that we've worked on is that partners have really stepped up. They have been able to transition to this kind of a structure quite well, build systems and processes with the support, of course, of the investors, performance managers, etc., to be able to actually deliver within these kinds of structures. As you might hear from some of the partners later, some of them have actually completely transformed how they internally work within their organizations, having brought in outcomes focus, not just in this particular program, but across the programs that they might be working on, having brought in systems which help them operate within this outcomes-oriented framework, etc. So I think that seems to have worked well again. Finally, the last one is that the bar is now being set higher. I think the big learning over the last few conversations has been that while earlier these kinds of instruments were being seen as pilots and were being seen as mechanisms by which you could try out different things, see if the ecosystem actually adopts it, and because some of these have worked, the aspirations now are, can we now move beyond sort of direct interventions, for example, in the case of education, to influencing systems, to sort of doing large-scale work rather than just focusing on particular geographies, particular areas, etc. So these are some early trends that have been noticed when it comes to how the initial hypotheses have played out. Maybe a couple more that I'll touch upon around how the entire the setup or design phase has evolved, right? I think there are two things that have happened, which I'd used the word infrastructure originally within the slide, which I took out and I replaced it with foundation. But I still think infrastructure is probably a better word, because what has happened over the past few years is that with this being, these kinds of instruments being set up repeatedly, there has been a baseline of data which has been created in certain sectors, which allows for hopefully future such instruments to be a lot simpler, to be set up in a sort of much quicker time frame, and allows for there to be more robust sort of decision making even as we set our sights higher. For example, as part of the Quality Education India Impact Bond, one of the things that was worked on was almost to think about how, one of the biggest challenges with these kinds of instruments tends to be pricing. How do you really price an outcome, right? Because if you take it from a beneficiary's perspective, it can be very different. If you take it from a donor's perspective, it can be very different. However, what we were able to do along with the consortium during that impact bond was actually come up with ranges of how different kinds of interventions translate into learning gains at what cost. So that's now basic infrastructure which is available to be utilized to build on top. Similarly, what you see on the other side is that now there are a number of organizations at all levels, donors, support organizations like us, investors, or implementing partners who now understand how these things work and understand the legal dynamics, of course, which are quite complex, and are able to operate within those. So again, promising trends, and hopefully this helps this ecosystem actually expand in the future as well. Maybe I'm going to pass it back to Aparna to talk about some of the broader sort of ecosystem level initiatives which are driving this forward.
Great. So, hopefully that gave you an insight as to, what are some of the instruments and what is the early evidence emerging, from those. Wanted to also touch upon, when we sort of step back and see, what are some of the tailwinds that are also supporting, the rising interest in this. So the first, of course, I think everyone's talking about it, is the social stock exchange. The idea is not new, but in India, this was introduced about 3 years back now, by the Honorable Finance Minister in her budget speech. And this is actually now taking shape, and I think a lot of you might actually have been involved in some capacity, shaping the narrative of the social stock exchange as to who gets to list, how do you actually measure impact, what are the kind of instruments that can actually list, or securities that can list on the social stock exchange. So a lot of this is actually lending itself to people, wanting to read up and learn more about such instruments. There is obviously the zero coupon, zero principal bond, which is nothing but, a grant, but it needs to be listed as a security. But a lot of the RBF instruments that Tushar and I talked about as well are going to be eventually listed on the social stock exchange, which will provide access to a lot more pools of capital, which traditionally maybe you've not been able to reach out to. So then, from that perspective, this could become really interesting as well. The second is, there is, like I mentioned initially as well, government in India is now sort of also looking at blended finance. This is not, a new term at all. I mean, when you talk about a public-private partnership, that's essentially what blending is. But now we're just, layering that on with an impact angle, which hadn't been done before. So very recently, again, Ms. Nirmala Sitharaman mentioned this, that they are looking to set up blended finance funds for a lot of the sunrise sectors as well. So there is rising, interest from within the government to explore this. There is an blended finance fund for agriculture that is being looked at under NABARD as well. The third is from investors' perspective as well. Capital allocators, owners. So a lot of the people from foundations. I think this could be interesting for them, because now they're looking at a more outcomes-focused way of giving. So not only does that impact foundations, but also nonprofits who could, position their work in a more outcome-oriented fashion. It doesn't have to be an impact bond or whatever, and that's just one instrument. But, can you really try and quantify to the extent possible, and try and measure that the impact that you're creating? So we're seeing, rising interest from a variety of different asset allocators as well. And then lastly, as Tushar also touched upon this, I think early on, back in 2015, when we saw the first impact bond in India, Educate Girls, this was about a $250,000 bond. To today, where you are talking about large-scale facilities such as Samrid or the Back-to-School Outcome Fund. Now we're talking, in the $30 to $50 million range. Samrid has actually been able to leverage, the philanthropic capital grant that they had received. They've actually been able to leverage that 10x, 12x. So we're talking about large-scale structures. We're talking about improved absorptive capacity within the ecosystem for both, not just nonprofits, but also for social enterprises. So we're seeing a lot of interesting things happen in the ecosystem. And then Tushar talked about the foundation being laid. So I think a lot of this is building up on that. Having said that, I don't think it's a very easy road to scale up. There are still a lot of challenges, that one needs to work. And there is, there are a lot of ecosystem actors who are actually taking up different bits and pieces of this and, working on that. So the first one, of course, is the regulatory complexity and restrictions. So with the social stock exchange, actually, some of this is coming to the forefront, and we do hope, that we will see some clarity emerging around how different forms of capital can actually be pooled together, the way we see it happen globally. We talked about the lack of quality and standardized data as well. So here I think institutes like ISDM are taking the charge, setting up the Center for Data and Philanthropy, trying to aggregate different sources of publicly available data, clean that up. So there is a lot of and other organizations as well. So there is a lot that's already happening in this space. I'll maybe touch upon just quickly awareness building and capacity. So I think that is increasing now with more and more people coming and talking about it. You will in the next session during the AMA hear from actually some of the non-profit leaders who've had first-hand experience working in it. What really worked with them? What were the challenges? So they'll touch upon that. And then, there are obviously the costs and complexities, but that's again because, like I said, the sector is still nascent and we're working through a lot of that. But as these instruments mature, as there is more awareness and understanding, we see a lot of this coming down as well. I'll maybe, Tushar, if it's okay, skip over some of this because we do have about 5-7 minutes more. So maybe we'll probably pause here. I think there's a lot of content that's already been discussed, and we can, I think, take some questions, and if not, then happy to kind of talk about some of the enablers, and maybe if you'd want to do that as well. I think there's a mic coming along.
Sorry, you want me to repeat again?
Yeah, just for everyone's benefit.
Yeah, so if you can help us understand what is the status quo on the SSE. What we understand and hear is there are about 6 funds currently being identified by GOI, and out of that, one of that is organization development stroke capacity building. And the initial fund size seems to be 1 million rupee or so. And so what is this current status, and when do we start seeing action there, largely go to market also? Whatever you think is relevant on SSE. Thanks.
Sure, I can try and answer a little bit of that. As of consultations that happened recently between BSC, NSE, as well as SEBI, who's regulating this, they are trying to operationalize, work towards actually operationalizing and getting a couple of transactions off the ground with zero coupon, zero principal bonds, because that's a simpler security to list. I think further down the line, you will have, see some of the other RBF type of instruments that we talked about. There is a capacity building fund. I think you were referring to that as well. And I believe, I think NABARD and SIDBI are coming together to pool funds for that. So all of that, sir, is actually in the process. It is happening. And I think some of the most recent consultations happened about a week or 2 weeks back in Bombay between NSE, BSC, SIDBI, SEBI. They'll probably be in a better position, or maybe if somebody here from AT Chandra is there, who they can probably answer that, because we're not as closely involved on that front. But there is definitely action, and I know I don't want to put a date to it, but they were, last I heard, wanting to do something as early as even October or November of this year. I could stand corrected on that, but if it's anybody in the audience, or maybe Tushar, if you have more recent information on that, please add.
No, nothing much to add. I think I was part of a recent conversation where going beyond, I think ZB's SEBI has already sort of thought through some of the other structures, like for example, how could outcomes-oriented structures through the ZCZP route actually be operationalized, etc. So I think there is some nuanced thinking there. Of course, as everyone might be aware, I think listings through the stock exchanges have started happening. But again, wasn't privy to, I think, the latest consultations. Yeah.
There are, I think, close to 30. Oh, yes, ma'am, please.
Yeah, I'm Jyotsna Sidling. I'm a member advisory committee to SEBI on social stock exchange. So given that whatever had happened on 11, basically, I think you are also there. Yeah. So given we are trying on level base to onboard, basically, about 30 NPOs, non-profit organizations, they have already, listed, 33 of them. But out of them, how, now getting them registered, getting them listed is fine, but getting them registered is taking a lot of time right now. And basic exercise on that day was to, how to how to fine tune mainstream logic model into these exercises, and how to make the project in a way that it becomes understood as a framework by all the stakeholders concerned. Yeah. So we have given the framework, we are doing the exercise, and I think they will come back with those exercises. After that, again, second round of meeting would be held. It's a sort of pitching, basically, right now, where the funders had also come, BSc, NSC, and other intermediary organizations were also there. And it was a good time for all of us to understand, what this, operationalization of this social stock means in terms of mobilizing the capital, in terms of building the capacity of NPOs. And I must say that there's 100 crore fund. This is basically, it's mobilized from all, basically, BSc, NSC, NABARD, CIFSI, and NABARD has been given the responsibility to, to coordinate all these exercises. So this much I can tell right now. Thank you very much.
Fantastic. Thank you, ma'am.
Thank you.
Good afternoon. My name is Shiv Rao. I'm here. This side on the left.
Oh,
Okay. So I'm the founder of 3R Zero Waste, and so it's a private limited company, and it's a social sector where I'm trying to work. So I call myself a social entrepreneur. But when I started an NGO as well, Section 8 company, because I know nobody is going to give CSR funds to a startup, right? So I started funding my CSR activities through my company, and I am running this for the last 3 years. So my question is specifically, if you go back to your chart, the two charts, climate change action was 4% per volume, and in terms of value, it was 0.4%, right? As per Terry Markle's model, to India to achieve net zero, India has to spend 111 trillion US dollars to achieve that. So, and if the social sector is going to play a very crucial role, it cannot be by the industries taking care of all the net zero and the climate change, because it will be changing of mindset of people, how we take care of our environment. So how do you see this sector, and what sort of numbers you see in the next 5 years or a decade in this sector? Thank you.
And sorry, so, just to clarify, your question linked to more the climate linked sectors. Yeah, I mean, I can talk about some recent conversations and the traction that we are seeing, especially when we think about how some large movers in the space like global multilaterals or global funds are thinking. Based on those conversations, it seems like I think it's at that space where the sector is at that space where there's a lot of capital sitting on the sidelines. There's hundreds of millions of dollars of capital which is waiting to be deployed. I think they're looking for the right kinds of structures, the right kinds of mechanisms by which they could move forward, especially when it comes to blended finance. I mean, on the commercial side, of course, a lot of money is flowing in, a lot of it is moving. So the chart that you saw was, of course, focused on how much of it has gone through the blended route. And I think that is where there's a little bit, a little bit of, I wouldn't say pause, but there's this sort of calm before the storm in some ways, where there's a lot more money, which I would say could be expected to come in. However, at this point of time, there's potentially just, some exploratory work, some work being done by these organizations to figure out what is the right method of engagement and what are the right organizations to be investing in. To an extent, this is being driven by the government as well. You've seen how, the recent announcements, etc., and the government itself setting up a sustainable finance working group and wanting to, channel some of their money through these kinds of instruments. So I, and then this is entirely based on conversations, other conferences that I might have attended. But that's basically the state where it seems to be. I hope that answers.
I can just add to that. I think the 0.04 that you saw, I mean, the energy was one of the largest along with financial services, right? So climate is not really a sector, it's a theme. So you would see some of that in agriculture, you would see some of that in energy, like clean energy, solar. I mean, those are some of the biggest sectors, if I can call it that, or themes that have involved blended finance capital as well. So this is based on some, self-selection by the people who've done blended finance to choose whether they, would like to put it under energy or put it under climate. But climate as a theme is obviously very large, cross-cutting, and everything. And we were talking about this in the morning as well. There is no denying the fact that that is going to be the largest place where you'll see capital flowing in. There is just tremendous amount of impetus from all stakeholders now, be it government or commercial capital or even foundations. And it has an impact when you look at ESG. It obviously has an impact on S as well. So you cannot sort of slow down the pace at which the funding is going to go into environment or climate.
Hi, can I ask a question?
Hi, Arun here.
So we'll take these two questions. We're just running a little bit out of time, so we'll take other questions offline.
Okay, Arun from Magic Bus. We are one of the implementing partners for the Skill India bond. A lot has been talked about market size for CSR. We know what the number is, and the other streams of funding for social sector. But this whole new stream called blended finance is in an infant stage. But as the slides show here, there is a huge outcomes in terms of efficacy of the outcomes. Tushar, since you've been a part, Dalberg has been a part of many of these bonds in terms of the PME unit managing the whole performance. Can you put a finger to say 5 years down the line, what would be the market size for a blended finance? Two reasons why I'm asking, because I think there is a lot of appetite of people able to take risk and innovate. And we see that that's another instrument to really solve some of the pressing problems in India. I want to hear that number. What is that? And is it 50%, 40%, 30%, 20% of the CSR market? And if you have to make it 50%, second question, what do we do as a group who believes that blended finance could be a very strong instrument for solving the country's problems? What is that 2-3 things we need to do? Two questions.
Other question as well, and then
Sure, thank
there's
you.
one more.
Yeah.
Question.
Hi, I'm Shoikat from XLeap. Thanks for the session, very informative. Very basic question that I think on the education bond that you were speaking about, there was a number mentioned in terms of the financial returns that came in. I don't remember the number, but I want to understand, how is financial return being calculated on an education program? So if you could help throw some light on that.
Sure, sounds good. Should I go first? So maybe starting with the question that Arun had. I'm going to disappoint you by not putting a number there, but you've seen the trend. I think the trend is positive. I think especially, and you refer to the skill impact bond. I think we at least within Dalberg, I think the house view here is that this is sort of a starting point. The skill impact bond essentially helps prove that approaches of this kind work in the space. And if that can be used as a pathway to potentially influence significantly more philanthropic capital, but also hopefully at some point of time government money which is going into the space, then the total size of the market is very large. So I mean, you could put whatever percentage number that you would want to it, but I mean, this is at this point of time, just for reference, it's a $17 million instrument, which is quite tiny when you look at the problems of the sector, and $17 million the skill impact bond, which is quite tiny, and that's over 4 years, right? And which is over 4 years, right? So if you think about the ecosystem and if we combine everything that is being spent, it is multi-billion dollars. So even if we are saying that, look, 20% of that is to be outcomes oriented, we are talking about a fairly large number over the next 5-10 years or so. So I mean, at least in that space, my personal belief is that it's at the cusp of potentially scaling up a lot. Of course, how we jointly work together to prove it, I think, is important. However, I think that, and then similarly, I think for a number of other sectors, I think there's a lot of conviction and belief that sectors like financial inclusion, climate are ripe for these kinds of interventions, and therefore there could potentially be a lot more action there. So maybe not putting a number there, but the view is that the growth can be fairly significant. I don't know, 20, 40, 60, 100%. The hope is that it's higher, but yeah, it can be expected to be, especially because the base is small. Also, let me highlight that. I'm not saying that we are starting from $1 billion base and then growing. The base is small, therefore, hopefully, the growth will be significant as well. So maybe that's answering the question.
I'll just add again, not putting a number to this, but where our aspiration is, I think if you go back, say, 3 or 4 years, the whole climate bond market was maybe, globally speaking, $140 billion. It doubled right after that, globally. As of last year, I think it's almost, or this year, it's going to touch $1 trillion. 1 trillion this year. It's on the path to scaling that. I think that's the kind of aspiration with which we need to work, and that, I think, going back to the question you'd asked, like, where is all the money? It might not be on the charts here, but there is, through all these blue bonds and green bonds, climate bonds, it is, the commercial investors are saying that I have to do this because consumers are asking for this, institutional investors are asking for this. How do we channel that towards some of our interventions? Okay, that's a different example because I'm talking about climate bonds, but how do we now, closer home, get that kind of scale? I think the answer lies in simplicity. The reason why they're able to mobilize that kind of capital is because the structures are simple, the financial markets are able to understand it, there is familiarity. So I think as ecosystem players, I think that's the task we have at hand. How do we move from these bespoke, small, slightly complex structures to something which is simply understood by the financial markets, where the largest pools of money today are sitting? How do we then bring that into working for us in social impact?
Yeah, I think second question, I think the return numbers that you saw were essentially because the impact bond structure essentially assumes that donors pay on outcomes, and an investor comes in to provide the working capital. Those numbers refer to what is the return the investor gets for taking the risk. Because the investor only gets paid upon outcomes achievement. So they're actually taking a risk on whether the outcomes are achieved or not. And that number that you saw refers to that return that they get if outcomes are achieved. I think that's an important part, if outcomes are achieved. And also at a very high level, I think the importance of nuance here is that additional cost should seem like a small number because the outcomes achievement should be significantly higher. I think that's the objective, and that was also the driver behind sort of touching upon some of the outcome numbers there.
Hello, I have one question. So my question is with respect to the development impact bonds here. Can you hear me? Yeah. So Educate Girl was the first organization in India that got the DIB. But my sense is that primarily because they have developed some cutting edge technology, which is some algorithm that make them most cost efficient organization in India. That's what they claim. And also that, that also improve the impact and the social return. So that enable them to get the development impact bond in. But what about the organization, small organization? They are doing quite good work, but they don't have money to invest in technology, to leverage technology to create impact or return at a scale.
Yeah, maybe a really quick answer. I'm happy to have a sort of longer conversation because I realize we are probably running out of time as well. Should I just take 1 minute maybe to quickly answer that? Yeah, I think it's not, and would love to hear from where the hypothesis comes in. Technology is an important part of any intervention, and then technology can help improve the quality and type of returns or outcomes that you are able to actually deliver. However, technology is not necessarily a fundamental part of actually selecting an intervention. I think where technology becomes important is, are you able to have systems through which you are able to actually measure these kinds of outcomes? And these systems can be developed over time. One of the important aspects of impact bonds over the past few years has been that let's select the interventions that we believe can deliver outcomes. And then often organizations would have some systems in place, of course, because they would be collecting data and looking at what outcomes they're delivering. However, those systems might need to be strengthened. So can we invest in those kinds of systems through the program as well, or help these organizations who are implementing develop those kinds of systems? So technology is not a primary anchor for the selection of which organization goes into an impact bond. However, it's an important enabler for the success of something of this kind. And whether it's a small organization or a large one, yes, as Aparna mentioned, some of these capacity elements do matter when organizations are selected. However, I would again maybe just push back on saying that technology is the primary determinant of a selection of a particular organization. I hope that answers your question. Happy to have a more detailed conversation offline, but maybe I'll just pause here.
Thank you so much, Aparna and Tushar. We will now move to the next segment of the same session. So in this segment, we have ISDM Center for Innovative Finance and Social Impact, where they will be launching their findings from a landscape study on the domain. I request Dr. Riya Sinha and Priyanshi Chauhan from ISDM to present the brief findings.
A very good afternoon, everyone. The Center for Innovative Finance and Social Impact, which is a Center for Excellence at ISDM, is delighted to launch the first ever report on innovative finance, which is titled Bridging Perspectives, Innovative Finance Insights from India. The purpose of the report has twofold purposes. First is to demystify the knowledge of the existing innovative finance instruments, primarily from the SPOs or the recipient organization's point of view. Though in this report, we have tried to capture both the perspectives of the donors and the recipient organizations, but as the narrative on innovative finance is extremely donor-driven narrative, our center has tried to make a paradigm shift in this narrative, and this is the first ever report from that. And the second purpose is to delve into the perspectives of both donors and recipients, and thereby advocating a comprehensive platform and understanding coming together for integration and collaboration. So the moot question here is, why innovative finance? So as we all know, the government is the primary contributor to the social sector, almost contributing 95% of the funds, followed by philanthropy and CSR. And definitely, there has been slight increase in the philanthropy and CSR funds in the recent years, but definitely there is also a significant gap of $94 billion to achieve the SDG goals in 2022, which is expected to increase to $152 billion by 2027. Moreover, traditional private financing comes with several challenges, several constraints. Philanthropy funding especially relies on the benevolence of individuals, corporations, and foundations. And obviously, government funding is subjected to limited budgets. So this often leads to multiple sectors vying for funds and resulting in social sector initiatives not receiving sufficient financial support. This definitely leads us to create and explore innovative finance and alternative financing models and instruments to finance the social sector, with a focus on channelizing funds from the private sector and creating a social impact. So, understanding what innovative finance is, now there is definitely a general acceptance that innovative finance refers to financial instruments, it refers to approaches, mechanisms which are designed to achieve the social goals, but definitely there is no widely accepted or agreed definition. Based on whatever definitions we have seen from the multilateral organizations like OECD, IFC, World Bank, a common objective which comes out on innovative finance is to close the funding gap to achieve the development goals and social impact, and incentivize funders to invest in organizations that are aligned to these social goals. The study presently has three objectives. The first objective is exploring innovative finance instruments which have been already implemented in India. Second is assessing the trends in the innovative finance landscape in India. And the third objective is assessing or understanding the supply and the demand side challenges, which means the challenges perceived by both the donors and the recipient organizations. Now I will request my colleague Priyanshi to give a brief on some of the instruments, though most of the instruments have been covered in the masterclass, and also talk about some of the challenges.
Thank you, Ria. Hello, everyone. I will not go into the details of the instrument because these have already been covered. But what you can find in the report is the information regarding the structures, stakeholders, processes, value proposition, who does these instruments apply to, and what are the anticipated risks for each of the instruments. So if you're interested in learning more, please go through the report. Moving to the trends, based on the data available, there are three top takeaways. First is that the growth of the sector is attributed to the donors who want to make this their funding more effective, and also the opportunities being created by the evolving markets. Second, there is a general preference for financial returns over social returns, which raises some important questions, what it means for the sector, especially for the not-for-profits. And third, that there's a simplicity, there's a preference for simplicity of instruments. So in our way ahead, we need to reduce the cost of transactions in building these instruments. The report has also touched upon some of these challenges, both from the perspective of the donors and the demand side perspectives. From the donors' perspective, the focus is around lack of data, information, and clarity and credibility of the organizations, inability to pool different forms of capital, lack of a pooling vehicle, complex structuring of financial instruments, ambiguity in defining impact and attribution, cultural challenges and mindset challenges among the recipient organizations if they are able to build their capacities to actually participate in some of these instruments, and the trust deficit between donors and recipients. From the demand side perspective, if we look at the not-for-profit sector, the focus is, the challenges are majorly because of complexity in building a relationship with the donors. There's a lot of focus on programmatic outcomes as compared to building organizational development and resilience, which are important means to achieving those outcomes. Increased complexity of compliance and high reporting requirements, and also the question of value addition, especially for the not-for-profit sector. For the for-profit, the challenges are majorly around the scale limitations and the quantum of funds available, ambiguity in defining impact, challenges posed by the CSR regulations, and lack of long-term finances. Now, given these challenges, there's a need to rethink innovative finance practices, which need to focus more on long-term partnerships, balancing trade-offs between social returns and financial returns, collaboration and knowledge sharing amongst all the stakeholders, focusing not just on programmatic outcomes, but also building organizational capacities and institutional resilience, and finally, measuring impact by including the perspectives of the recipient organizations as well. So if you're interested in learning more about these things, please refer to the report. And I again invite Ria for the final remarks. Thank you.
So talking about the roadmap for the future. So first, definitely, this is a kind of a general roadmap which we have created. The first is knowledge creation and collaborative learning. Obviously, we need to really create a lot of knowledge about innovative finance instruments. What is the value proposition of the instruments? What are the one-on-one of the instruments? And help the recipient organizations or the implementing organizations to better understand what these innovative finance instruments are and what are the prerequisites or the eligibility criteria. The second is profiling of reputed recipient organizations and donors for potential innovative finance deals. So obviously, some kind of a profiling need to be created for both the recipient organizations and the donors. For the recipient organizations, we need to understand who are the potential recipient organizations who can be eligible for these funds. And of course, the donors can help them provide those funds. So some kind of profiling of this is required. The third is of definitely multifaceted stakeholder engagement is required, because we need to bring all the various categories of stakeholders like the regulators, the recipient organizations, the donors, the intermediary organizations, all on the same platform, and basically explore opportunities and harness opportunities. The fourth is capacity building of donors and recipients. Of course, we require to build capacities knowledge capacity and also the technical capacities which are required to leverage the funds. So capacity building in every form is required, both for the donors and the recipients. And definitely another is tailoring cost-effective instruments for the social sector. Definitely, the recipient organization needs to understand what instrument is, it's very much eligible for them and what is required for them to get access to those kinds of instruments, and definitely conduct a feasibility study based on that. So definitely these are the 5 most prominent steps. CIFSI is going to pick up each one of this in future and delve into more research. The details of this particular report is available on the CIFSI website. So I will definitely request all of you to download the report and view the details. Thank you.
Thank you, Ria. Thank you, Priyanshi. We'll move to the final segment of this session. Just a heads up that this session will spill a little over lunch, so please plan your timings accordingly, because after that, we again resume at 2:30 after lunch. Okay, I welcome Ms. Anushree Parekh. Anushree is a social impact consultant with 13 years of experience in corporate social responsibility, public policy, and not-for-profit sectors in India and UK. The next session is Ask Me Anything. Over to Anushree, who will introduce our guests, and then we move forward to the session. I would request our speakers to please come up on stage. Thank you so much. Rahul, just check the mic. Just check if Anushree's mic is working.
I know we're sitting between you and the lunch, and so we're going to try and keep this really short and punchy. The first session, the masterclass, was all about the theory or the 101 on innovative finance. We then heard the ISDM report findings on what the landscape looks like and what the stakeholders sort of feel and believe and perceive this to be. This session really is about the practice of innovative finance. It is an Ask Me Anything session. In the spirit of this session, really the goal is to have a very candid, honest, open discussion and reflections from our panel members on what does it really mean to be a part of an innovative finance structure. I'm joined by some very experienced individuals who lead very credible and well-respected organizations. From my right, I have Dr. Dhir Jhingran, founder and executive director of Language and Learning Foundation, or LLF, as we all know it. On my left, I have Surbhi Kakrania, the Chief Financial Officer for Hakdarshak. I then have Jayant Rastogi, who is the founder and CEO for Magic Bus. And lastly, we have Chittaranjan Samantaray, who is the Head of Projects for Pan IIT Alumni Research for India Foundation, or PARFI for short. We really want to open this up to the audience, but just to get us started and warm up the discussion a little bit, I'm going to ask each of my panel members here to spend maybe a short 2 to 3 minutes giving us a flavor of why they decided to become part of an innovative financing instrument. And all of them have first-hand experience of actually implementing one. So what was the motivation? What was the one big advantage that they saw in becoming part of this? And what were some of the challenges or learnings that they realized as they carried on with this journey? So I'm going to start with Dr. Dhir. Thanks.
Thank you, Anushree. Our first experience with impact bonds or innovative financing, it actually happened to us. I mean, we didn't seek it out. We were at a point where we were trying to scale up a demonstration project that we done in 2019, and Social Finance India, which was curating a kind of bond which was guaranteeing social impact came to us, and we were happy because we were working with the government and wanted to reach 7 districts in Haryana. That was the first bond that was completed in 2022. Our motivation was multi-year funding, doing what we wanted to do at scale. Later on, we actually developed a model where the key to the model was to work with the system, the education system of the government, a very indirect model. We internally call it a low-touch model. The idea is to enhance the effectiveness and efficiency of the government system to be able to deliver good foundation learning outcomes. So we are catalysts, we are embedded and working with them. This was a model that we evolved, and we're really happy over the past 2 years, at least 3 such innovative financing organizations, funders, were quite aligned with this and happy to support an indirect model. And we believe that you really can achieve results at scale if you work with the system, and these outcome funders were ready to do that in an indirect model. Of course, we take accountability for learning outcomes of children. So that's how it was sort of very well aligned with what we were wanting to do. In terms of learning, I think we realized very soon that there's need to track outcomes internally on an ongoing basis, and which means that collecting good data, analyzing it well, and also prioritizing it. There's lots of data that flows. What exactly is going to be the most, the indicators, the interventions that are going to make an impact, and track them on a regular basis. We also learned, and we anyway stood for that you have to strengthen the system if you want to achieve outcomes at scale. You can't do things individually. So it's about working with the system while you're implementing an innovative financing project. We also know that third-party evaluation is an integral part of any such innovative finance because investors look for results. And we've grown quite comfortable with third-party evaluations. The one thing that we have seen is that any organization that is going in for a third-party evaluation as a part of a fund, it's important to see that the framework of the evaluation is very closely aligned with the outcomes that we are supposed to achieve. So it's very important to do that. And after that, I think if you're confident of the fact that your intervention works, there's no need to be afraid of third-party evaluations.
Thank you, Dr. Dhir. 2 big takeaways for me. One is model alignment or a mission match was key in your decision making. In terms of the learnings, basically good data tracking, prioritization of metrics, smart sort of data management and integration with programming. With that, I'm going to actually hand over the mic to Surbhi. Surbhi, you have a very interesting structure. You are a for-profit organization, but clearly seeking social outcomes. If you could just talk about your motivations and experiences of innovative finance. Thank you.
Thanks, Anushree. Hi, everyone. So I think the biggest motivation for us to work on this model was to scale. In last 3 to 4 years, we have reached about 3.5 million people. The next 5-year vision is to reach 100 million people. How do we do that? If we don't have any innovative financing model, how do we do that? I mean, we have cracked the operating model, we can develop every year. But if we want to do that 10x times, and I think Aparna covered that we need to figure out that spot in next 5 years, the vision mission that, okay, this is what we want to reach. And then we work backwards. So I think the motivation was the scale, the speed of the scale. And the idea was that in terms of designing it, and like all the parameters which are covered in the presentation, starting from a risk investor to an implementation partner like ours, and then the outcome funder, which is mostly a philanthropic donor. Then the government is also part of it. And then there's a evaluation committee, which is very independent. And then there's a legal framework around it. I think it is complex. It is one of the biggest challenges. So the motivation was the scale. Challenge is getting so many stakeholders in one room and getting a yes. I think getting one yes for an innovative fund makes it very easy for the others to believe that yes, this will work. Because end of the day, it is absolutely on Excel sheets and documents. It has not been proven otherwise. It is innovative. So for any innovation, I think first thing as a challenge is getting a consensus in a room full of people that yes, this will work. And then you basically go in with a very detailed operating and financing model that how you can, uh, completely channelize the funds which are getting used in what way. And again, reiterating the fact that data evaluation is a very key part of it because outcomes are driven only out of that. So I think that is something we internally have followed and designed back and spoken to a lot of stakeholders in terms of how we can structure it accordingly. And so it can reach that kind of scale and is reaching to the end citizen. So yeah, that is.
Thanks. So, Surbhi, you've spoken about scale and the speed at which growth happens as your motivation to participate in innovative finance. A learning really has been around building consensus among a very diverse set of stakeholders, all of whom having different priorities and not just building consensus, but then actually taking them along, managing them throughout the project. I'm going to now move to Jayant. Jayant, Magic Bus obviously has been doing some fantastic work in skilling, very well-established models as well. So I'd be really interested to understand from you as to why you thought of participating in the Skill Impact Bond. What was the advantage? Has the promise really borne out? But also, what are some of the challenges that you faced?
So, I think, somebody mentioned, organizations at different stages, and our objective was very different. So firstly, when we got kind of invited or we applied for the bond, the first question was that if you don't meet your outcomes, what happens to you, right? You don't get your money, so there's going to be deficit. So how do you cover that? Also, how do you take it to the board? The second question was basically, would we be able to perform? Because there's also this whole name and shame kind of a thing, if you kind of get dropped because of performance. We have a performance-driven culture, so we thought, okay, that part was kind of answerable. The question was, how do you cover for the deficit if that is the case? Because there are times. So we thought about it, but we thought that the benefits far outweighed the risks which were there. We thought it would create good visibility. See, we were already at 100,000 odd, in the skilling on the skilling employability skilling side. So we were scaled, but our ambition is much larger. So we thought if it gives us visibility, we would have opportunities to raise funds and do something more with it. So that was, I think it was a fairly simple discussion. Took us some time to and fro, but I think we decided to go ahead. But I'll tell you what are the advantages that, which are from a very practical point of view, as an implementation organization, what is it that we learned from it? Firstly, it is stressful, right? It is stressful. There's a lot of data analytics which is required. And yes, I did hear, I think, one gentleman over there actually asked Tushar this question, whether you need technology or you don't need it. So you need to have good processes and you can develop the technology later on. And that's what we've been on the journey of kind of, building a technology part of it. There's a huge amount of data analytics which you can do. If you choose not to do it, it's up to you. But I think, I'm sure we all understand the value in terms of the data analytics part of it. When we actually started on this path, it was the prestige. It was to be associated with, one of the first probably livelihood impact bonds in the country. So there was obviously that associated with it. And there was this pressure how to kind of, work in terms of, very strong processes and deliver, whatever the performance. And I'm very lucky that, I have a very, very enthusiastic person in my team, Arun Alwadi. If you could just stand up, Arun. So he was driving this whole thing. And and when we ventured, actually, we made a lot of mistakes. We were supposed to submit the data to our funders, which was NSDC, and we realized that in one of our programs that we'd done, we realized that the data was not accurate. We got to know through a whistleblower policy. People came, told us. We acted very swiftly. We actually set up a team of people who were actually then starting doing data analytics in terms of triangulating the data from, we've put cameras over there, we've got biometrics, we've got a whole lot of technology over there, triangulating and seeing that, people who were actually attending the session were really attending it. People who were kind of, we were seeing that we placed them, they were actually getting placed. So we started building that whole platform, and we actually set up the first, I call it the FPD, which is fraud prevention detection, which we rolled out. A team of people which are scrubbing 100% of data. We've rolled that out to all our other programs also now. So in fact, building that integrity. I'm sure there are a lot of doubts, and I heard some questions in previous sessions also about the impact and the integrity of the data, So we brought those practices. Our intent is good. I think there's good learning in terms of, what we can take to the other to what we do on the other program side. So other than data analytics, it's a very, very performance-driven bond. It is stressful, and I think like I said, it's not for the faint-hearted. It requires a real rigor in terms of going ahead, deciding for it. There have been very, very good partners who've not been able to kind of perform. But what we also learned was that this was also a chance to pick up certain things which are really, really risky, things which are very difficult to do. So we focused on gender, and we all know women's participation in formal workforce in India. What is the story, right? So we decided to focus on that, and as a result, we got we've almost now 70% girls who are part of it. We also learned what were the challenges associated with getting these girls into the formal sector. So in terms of working with their parents, how do you mobilize them? How do you ensure what kind of jobs you provide them? How do they kind of stay successful? So there's been tremendous learning for us. As a result, we've seen that the transmission rates, when you talk about, post-placement, 3 months of retention. So we've been kind of, it's been going up and up for us. It's at 74% now, whereas what I'm told is, I think, for the sector, it's actually south of 30%. So I think tremendous learning for us. Lot of things that we've rolled out to the other programs. It is, again, it requires a lot of dedication, a lot of focus. And but I think it is something that I would definitely encourage. If given a choice to kind of go for it again, it is stressful. I would think about it, but I think I would still do it again.
That's very brave of you, Jayant. But the key points really to note, one is just the risk of underperforming or failing, which doesn't just lead to a financial risk, but more importantly, a reputation risk in the sector. The other very interesting point, Jayant, that you mentioned was having an internal champion, right? Because as much as, we talk about donors and the need to really convince our committees and boards, I think it's a similar exercise even within implementing organizations. And on that point, actually, Chittaranjan, I'm going to move to you because I know some of your learnings have really focused around internal sort of education and internal selling. So if you could just tell us, some of the top sort of advantages that you've seen, but also a few learnings and how you've then addressed those.
Thanks, Anushree. So we are part of the Skill Impact Bond, and Pan IT in general, we were mostly focused in for our impact. Our relations with the government is very good, but what we have always realized is somehow we don't market ourselves well to all the stakeholders. So the Skill Impact Bond gave us that opportunity okay, so there is a host of stakeholders who are coming here. And of course the visibility increases, future fundraising and everything, so that is good. Apart from that, there is the best practices which are coming in Skill Impact Bond. So that is required for us to adopt as we are at the cusp of scale. There are several benefits once we came to Skill Impact Bond. First was, of course, there is a very good peer group. So they are the best among the best, and it's really every day is a new learning experience. We learn from them. They also, I suppose, learn from us, and that is actually how you build the entire sector as a whole and increase the impact. The another critical thing here in the Impact Bond is it's entirely focused on innovation. It is focused on outcomes, right? So unlike a regular, say, a scheme or a program-based funding where the pathway is defined, what you can spend on is defined. Here, you can innovate. You can find out which innovations work. You are encouraged to fail. You find the interventions will work. And that has actually helped us. Like we started experimenting on women, placing women in non-traditional sectors like manufacturing, etc. It wasn't a success at the first cohort, but ultimately it worked out. But these are the learnings which the bond structure actually encourages, and finally we find out how we achieve those innovations. The key challenges, if I would say, like, of course, it was challenging to get into the bond, but it's even more challenging to get a buy-in from your team, which is your operations team, who are the feet on the ground. And suddenly, like, they are used to working in some sort of way. And one fine day you say that, okay, you get me tons of data, you get me tons of these proofs and everything, and you have a strict timeline attached to that. So that requires, selling internally. That requires, basically, we have to impress upon the team that there is a vision of the organization, and whatever we are doing, the additional data, the data integrity, these activities are critical to attain that vision. And what we have realized is the operations team is more than happy and more than willing to do these additional activities, as long as that open conversation is there. So that conversation has to be frequently done with the team, and then once that buy-in is there, I think it's kind of smooth sailing from then on.
Thanks, Chittaranjan. So taking away peer learning, which of course is a very important sort of, externality of these instruments. The ability to experiment, innovate, Jayant also touched upon it, especially because risks are shared and you have good hand-holding support available from the consortium. And obviously sort of internal buy-in. Okay, I'm going to open this up for questions from the audience. I'll take maybe 3 questions and then direct them to the panel. Remember, the only bad question is the one that is not asked, so please just feel free to.
Hi, so my name is Imani, and I think question is open to all the panels. What I want to know is, of course, we've been discussing the advantages, so I would, if you can highlight what are the disadvantages of the innovative finance model, that would be great. The other part of the question is, being part of an implementing organization, of course, for years, I think, when we talk about different players, which is basically donors, implementing organizations, like the equation is as such that, donors are treated like God. For the reason being that they're giving us money, right, for running our model, our intervention, right? And that's what we need. Like, at the end of the day, we're somewhere or the other, we're prioritizing, finances, we're prioritizing money. So I want to know, does this model bring all the players at the same level? How does it solve the problem to that? Otherwise, we're still talking about, money being the most important factor when we are running our interventions as implementing organizations. Yeah.
We can take one more question and then I can go to the panel.
Hello.
Like this? Okay, thank you. Thank you for the panel, Jen, especially for sharing your experience in terms of what went wrong and what was some of the internal things that got surfaced during the process. My question is to the entire panel. I would assume that the panel and the orgs that you represent would have experience in raising funds across different channels. So between your experience of raising funds from, let's say, foreign foundations, domestic foundations, CSR monies, and now with your experience of this new way of raising funds as well, what would you suggest to non-profits like us in this rooms in terms of the complexity, the scale, the amount, and then the compliance that is required also, just in terms of ease of access to this fund and then the reporting that also gets tacked onto it? What would be your some top 2-3 recommendations there for people who are starting to explore or starting to look towards these new models? Thank you.
Okay, so I'm going to ask Dr. Dhir to take the question around sort of just the donor relationships, stakeholder relationships in an innovative finance structure compared to maybe other types of funding. And then on disadvantages, I'll again ask Jayant and maybe Chittaranjan to weigh in a little bit. And then on the last piece around advice, I guess I'll just go to each of them. Rapid fire, 10-second sort of advice for SPOs who are actually looking to enter into innovative finance. We'll start with Dr. Dhir.
Thank you. Donors are gods. I don't think our experience tells us this, and this is 3 or 4 bonds that we are doing. I think it's the implementing agencies that are really the centerpiece. They're the real, everything depends on them, right? So we have not had a challenge of an unequal relationship, especially because what was mentioned in the master class, that the strategies can be changed, right? Of course, you may have to convince others once, but otherwise it's all up to the implementing agencies to decide what's the best way to achieve those outcomes. And we've never felt an unequal relationship. Of course, it's a pain in the whatever places to be working with, performance managers, contracts, reporting, etc. That does come with this. But otherwise, this sort of hierarchy, we have not felt that. And can I address the funds issue? No. Yeah. So on this issue of funds, I think you must keep a diversity of funding. This can be one part of your resources and activities, but it's very important to have a sort of very diverse funding base. You mentioned foreign foundations, direct CSR funding, as well as this kind of funding. And as we heard, this funding does help the whole organization to look at outcomes very differently. So that's very useful, which then permeates into other kinds of projects that you're doing. But it's always good to do several kinds of diversified funding.
I'll just take a minute to actually add to what Dr. Dhir said on the power dynamics. If you see the theory of impact bonds and the fact that implementation partners are treated as equal, but also the fact that a lot of the power dynamics between a grantor and a recipient comes from the fact that your money is linked to inputs and you're constantly reporting on inputs, the impact bond structure changes that. You get upfront working capital. There's a trust in you, there's a trust in your model, there's confidence that having gone through that due diligence process, your model is best suited to achieve the outcomes. And with that trust and with an investor sort of, sitting behind you who's taking that sort of leap of faith in you, the power dynamics start to definitely shift. They may happen gradually, but we've seen them shift. I'm going to go to Jayant and then Chittaranjan on the disadvantages of sort of, these structures.
I'll just first kind of add to, I think, what Dhir actually said, So I think building a diversified funding portfolio is very, very important, if you want to scale. And there are different types of, fundings which are there, and we've done that in Magic Bus. So one is CSR, the other is institutional, the third is HNI international galas, and then you have retail, and now you have a fifth, which is blended, and then there's digital marketing, which is also coming up. You could call it the sixth. Now, if I was to compare, I would say that, the CSR funding is very, very kind of outcome driven. It is very kind of, I would say, linear in the terms ki boss, ye bola hai, ye karo. Okay. Then you have the institutional, and I think the blended finance are, I would say that, they both have risk appetite. They allow you to do something new. So difficult for me to call out which is better and which is, but our own experience, maybe because it was the first one, I think the blended finance or the development impact bond was definitely more stressful because we have done institutional funding. We knew what it is. I think the rigor around a development impact bond or a blended this thing is far, far stronger and higher is my sense. And I'm sure there would be different experiences. So then coming back to the disadvantages, right? See, one is obviously, you could, so, as an NGO, if you're spending money, you need to recover that, right? So if you spend $100, you need to recover $100. But if you're not meeting the outcomes, then you would not recover that. So there's that deficit which you always have. The other one which I did mention was basically, it's also the reputational risk, right? You get dropped off, people might start talking about that poker performance is not good. So that's, I think, these are the two big factors if you really ask me, right? Other than that, you have to have very good, strong processes internally also before you get onto it. Because there's a certain expectation which the funders also come with, right? And we've seen that, there are some really, really good players who've dropped off this skilling bond because of, these issues. So not because they didn't have processes or, there could be other issues. So I think these would be the three big things which I think you really need to think before you kind of get into this. And again, a really good, strong management team, somebody who owning it up and who can drive this, right? And we had some such person.
I think one of the disadvantages is the time it takes to structure the bond and everything, right? So it took around, like, of course, the bond started last year, but it took around 1-2 years to just structure that. So of course, our feeling is that once it's a much more mature model that it would be faster implementation and everything. But right now, what I feel is structuring of that bond takes time. So you can't base all your funding on just impact bond. And of course, as Jayant was saying, it's focused entirely on performance. So we have to go through that only if you're confident that you can deliver. If otherwise, it's a reputational risk which is there, and you have to find other funding channels, of course, to fund that.
So I think in terms of piece of advice, 2-3 things which I've learned from my experience while going through, the whole exercise was that you need to be very clear in your narrative. What exactly would you want to achieve? How you want to achieve it? Devil is in the details. You have to go inside the room with all the stakeholders with absolute clarity that this is how we are going to do it. This is the kind of money we will need it. This is the way it will work, because again, because it's innovative, the clarity needs to come from your side. Being an implementation partner, it's your responsibility to tell the other stakeholders that how it will run. So I think that is one thing which I have learned while working on this whole model in last 2 years, that unless you are absolutely clear on your narrative and your timelines and what you want to achieve, it gets diluted into multiple directions, and you end up doing a lot of meetings and back-to-back iterations to it. I think so. The end of the day, you need to be clear that what is the aim and what you want to achieve. So I think that has been the big learning for us. And again, I'll completely agree with the co-panelist said that time is of essence here. Because if I want to do something in next 5 years, and there's this discussion that keeps on going in for 1.5-2 years, it's just not works. So I think that is something one needs to be very prepped up before starting this whole thing, so that the traction and the conversations are faster.
Thank you. So with that, we're going to end this short and sweet session, but our panelists are very much around, so please feel free to connect outside the room and let the conversations continue. Thank you.
I thank all our speakers, members of the audience, and the moderators for these sessions, all the 3 segments. I would now request Dr. Riya Sinha, Senior Manager Research at the Center of Innovative Finance and Social Impact at ISDM, to felicitate our panelists as a token of our gratitude and appreciation. I'll just go in a random order. So we'll start with Ms. Surbhi Karkania. Could you just come here, and can we have the bag, please? Thank you so much, Surbhi. We'll move to Ms. Anushree Parekh. Thank you so much, Anushree. We were just in awe of how well you were writing all the points and how nicely you were covering everything for the panelists. We now have Dr. Dhir Jhingran. Thank you so much. Next, we have Mr. Jayant Rastogi. Thank you, Jayant. We now have Mr. Chittaranjan. Thank you, Chittaranjan. And finally, we have both our masterclass teachers, faculty, facilitators on stage, please. Mr. Tushar Thakkar and Ms. Aparna Dua. Thank you so much for a wonderful session. And if all our panelists could come together for a group photo. Yes. Ria, the back. And if all 8, in fact, including Ria, all 8 of you could come together for a picture. While the picture is being taken, we'll have a lunch break and we'll resume at 2:30. For all the finance and philanthropy tracks, they will happen in this room. And for others, please move to Nalanda and Samrasta